Right there, hello. This is the first time that we've ever done a video recording of this. So we're sort of, if you're listening to this on a podcast, obviously you won't be able to see us. But if you want to see us, then we will be in colour for you. Yeah. So anyway, so I just thought I'd say that for those who are watching this video, I would say that Ralph has got his book that he wrote behind him called Happiness Rules. He's done the classic thing that politicians have been doing all the way through COVID, which is sort of curating their backgrounds in terms of what kind of stuff they read. So anyway, so basically, you need to get more of Ralph in your life, and you know, one way you can do it is by buying his book. Isn't that right, Ralph?
Oh, that's absolutely right. Yeah, my book is called Happiness Rules, and I'm not plugging it in any way. It's just by accident that it appears next to my name.
It just happened to be there.
Yeah, funny that.
Yeah.
And also, the other thing which is funny is because you said I was curating my background, I indeed did do that, and I got rid of all my comic books and shoved in some philosophy books which I borrowed from the library for just this particular occasion. Absolutely.
I mean, that book that you normally have in the background, you know, The Hungry Caterpillar,
yes, thank you.
know, is not there. I noticed, and the Cat in the Hat, of course. But
can we start the podcast, please?
Yeah. Sorry. Yeah. Okay. So okay. Brilliant.
It's getting uncomfortable for me.
That's fine. Now, what we're going to do is, I've just got my phone here. We're going to try and limit this to about 15 minutes per topic, and we're going to do we're going to look at two areas today. And by the way, that is I am wearing a Watson's Daily cap here.
Watson's Daily hat, absolutely. Which is the reason why I also felt compelled to wear a hat. Unfortunately, the only hat I found was that manky thing which I've got on my head. So for anybody who's watching, sorry, you're stuck with that one.
Okay. Right. Anyway, so today, what we're going to talk about, tech, and we're also going to talk about company. This is a bit unwieldy phrase, but companies that are going to do well in a rising interest rate environment. A rising inflation environment. Anyway, so that's what we're going to talk about. Without further ado, let's go and talk about tech. So tech this week. I think it'd be fair to say that Twitter was a major part of the conversation. We had Elon Musk actually buying the company for a lot of money. Soon after the announcement, Tesla shares went down. Everyone said, everyone's worried, or investors are worried about him having to sell shares in order to finance his offer for Twitter. But actually, it turned out later in the week, filings said that he had sold it. So I guess there's a bit of both, like investors selling off, saying, oh, he's going to sell, but also him actually selling. He did then say later on in the week, that's it for now. So he's got no plans on selling any more Tesla, which is good because I guess that puts maybe a line under it for the time being. But there you go. So anyway, so that's where we are on that. But I mean, what did you think about this then, Ralph?
Well, I mean, it's to an extent it was amusing because we had just talked about Twitter and a poison pill defense last week. And it's almost like 2 days after we talked about it that we woke up to the fact that the poison pill defense, such as it was, wasn't effective in this particular case because shareholders of Twitter had sold out to Elon. Now, essentially, I don't really know what to think about this. I mean, Elon Musk has always been and continues to be this sort of champion of free speech. And he's already very clearly talked about this particular mantra of free speech in the context of his successful bid for Twitter. I don't know exactly where this is going to go. I mean, what he said is that he wishes to unlock the value in Twitter. I mean, everybody who's ever bought a company talks about unlocking value. I don't know exactly what that means in terms of Twitter
Hmm.
and what it means in terms of increasing free speech on the platform. Um, what it looks to me is, as yet, I don't really see any considered strategic statement from Elon Musk of where he wishes to take Twitter, and
Mm,
especially how he plans to unlock this value which he sees hidden in the platform.
mm,
It can go either way. I mean, he can, for example, allow people like Donald Trump back on the platform,
hmm,
which to me would perhaps mean a dilution of the quality
mm,
of the discourse which is being had on the platform, or he might be able to indeed enhance its profile.
mm,
I'm waiting to be surprised by what is happening.
mm,
If I mean, Elon Musk is a sort of well, is clearly an intellectually a genius
mm.
and a visionary entrepreneur, and it shouldn't be to anybody's
I mean,
surprise that we
I would
cannot
always
measure.
say he might be almost as intelligent as you.
Oh, come on!
Not quite, but he's
Surely not.
sort of up there. He's sort of up there, right?
Oh
Anyway.
dear.
So
Yeah,
yeah,
if only
yeah,
that would be
yeah,
nice, I have to
yeah.
say. But so we can't measure people like that by the
Mm,
standards of the rest of us, and so maybe it shouldn't be coming as a surprise that he sometimes acts in ways which sort of like normal people would see as a bit erratic, and
mm,
therefore. Yeah, the first thing he did was on his first day was basically slugging off the finance director of Twitter
mm, mm,
on Twitter.
mm.
So I don't know whether this is the sign to come in terms of free speech. I I simply have no idea. We haven't really seen um, a very informative press release by Twitter, so we'll have to see what's going to happen.
Mm, absolutely. No, I think so. It is interesting. I mean, it's interesting in the sense that it's a big thing and it's Twitter and it's Elon Musk. But actually, as things stand, I don't think it's that interesting per se because at the moment because we don't we don't have a plan yet. You know, they are going to be in limbo now. And I think quite rightly the employees will feel very unnerved because they just don't know what's happening.
Mm.
So anyway, interesting yet nothing really to get your teeth into at the moment. But clearly, everyone's going to be looking at what happens next. So I think that was worth mentioning. The other story that I really liked this week and found very interesting was the one on Spotify. So last week we saw that Netflix was sold off because they
Mm.
lost subscribers.
Yeah.
It was a shock to the market, and it seems that Spotify was sold off this week very sharply because investors are assuming that this is not just a Netflix problem, it's a streaming problem, and therefore the boom that they have all experienced over the course of the lockdown is actually losing momentum and could even, it'd be more serious than that, not just a slowdown, but actually a massive drop off. And I guess that a lot of these companies are going to be very keen on distancing themselves and saying we are not like Netflix because, and then dot dot dot. I think that that's what's going to happen. For what it's worth, I mean, I certainly feel that with in this particular case, I think you can distinguish more between, say, Disney Plus, Netflix, Apple Plus, and say Amazon Prime because they have their own proprietary. I mean, yes, they have various shows and movies, but they all have their distinctive. They all have their own production. They have proprietary content. But the thing is with Spotify, it doesn't. I mean, it's different. Music streaming is different, and I'd argue that actually music streaming is in a worse position than TV and movie streaming because they don't have their own stuff. I mean, the only thing that Spotify has that the others don't have is it has Joe Rogan's podcast, and that's about it. So I have said in podcasts this week and in Watson's Daily about how I feel that this could be an easy win for Spotify, and if they allocate a certain amount of money and buy podcasts, it will be way cheaper to buy a podcast than it would be to say buy a recording artist. And so I think that, and I would also suggest that many podcasters will be in a bit of a weaker negotiating position versus, say, Spotify than it would be if Spotify approached a recording artist with an agent, with a with a record company, and all that kind of thing. So I think that Spotify will be in a better position to negotiate with them. Anyway, I think that this is they don't need to go and spend like $100 million on every podcast they like. They could get smaller ones because I think that people. The reason why I think this is interesting because I think people they like certain podcasts, and hopefully people that listen to this podcast like this podcast. But they like podcasts, and let's say you're an entrepreneur and you like listening to a podcast by, I don't know, let's say Stephen Bartlett or something like that, right? And that's the Diary of a CEO or something. But anyway, let's say you like that podcast. I mean, I don't know because I don't actually. I mean, I listen to it a little bit here and there, but my point is that if you had something like that and that was exclusive on one particular channel, I think you'd be more likely to go onto that channel than you would if you say couldn't listen to Taylor Swift on Apple Music, for instance, because you'd be able to listen to it somehow, and it's only one artist, and apologies for any I don't know, what are they called, Swifties or whatever, I don't know what the fans are called, but anyway, so I don't know what they're I would have thought that potentially podcasts are stickier than music. But again, sorry, I've blathered on there a bit, but what do you think, Ralph, on that front?
Well, it's all very difficult. Again, I don't know whether that can necessarily be said, to be honest. If you think about, let me just pick up the last word which you said, which is sticky. So stickiness in podcasts really means repetitive continuing episodes. Mm-hmm. Stickiness in music means good music, which I wish to listen to again. I personally, I'm sorry, sorry guys, I've listened to Aerosmith and AC/DC and stuff, not Taylor Swift. And so if you listen to one song by AC/DC, you probably listen to them all, and they're all good if you like that one song. So listen to that one over and over again. And I want it to be there. When I'm in the mood to listen to it, I want it to be on my platform. And that is the stickiness for music to me. Whereas, of course, podcasts, much as I like yours, I wouldn't necessarily listen to one episode 50 times. So...
What are you saying, Ralph? I mean, what...
Sorry, have I talked myself out of a job here?
Taking this to heart. But anyway, yeah, carry on, yeah.
Oh, I'm so sorry. Oh, God.
Yeah. Sorry, carry on, yeah.
So, no, but the point is obvious. A podcast needs to be something which keeps the interest in its topic through recurrent and continued high-quality episodes. Music needs to do the same by just being good music that you wish to listen to over and over again. And obviously then the artist needs to come up with new stuff and new tunes, that is clear. But so the stickiness in music is, I don't think, necessarily so systemically different from the stickiness in podcasts. From the point of view of the provider, the streaming company, I think where they would differentiate themselves from other platforms in music is through the AI. How well does Spotify or Apple Music know me, for example? When I go on Spotify, I see, because you listen to X, here is some other stuff which sounds a bit like X. And
Yeah.
so you listen to it, and time and again I've discovered bands which I've never actually known anything about, which I didn't know existed. And so I like that. A friend of mine tells me that he thinks Apple Music knows him better than Spotify. So again, you have the AI. Yeah, I know that sounds
Isn't that
weird,
weird?
but
Is that weird? It's
we're
like,
moving.
well,
Look, we're living in the 21st century, you
Apple
know?
took me out, we had a few beers. It was good. Things got a bit crazy, but now Apple really understands me. That's the way it is.
That's the way it goes. That's the way it goes.
Spotify didn't do that. Spotify didn't spend the time with me.
Spotify's cross with me today.
Yeah,
You know?
yeah, yeah.
Yeah.
But anyway, yeah. Spotify prefers Joe.
Yeah, exactly.
Spotify likes Joe Rogan. Doesn't like me.
Horrible. I think I clicked the wrong button on Spotify today, and now I'm in the doghouse.
Yeah, exactly.
Yeah.
There you see. You go. There you see.
Yeah, okay, fair enough. So we are living in the 21st century. That's where the world is going to go. We're going to interact more with previously inanimate objects, fridges and stuff. But that's a different thing. So anyway, so there we are.
What you do in your own time, Ralph, is, that's all fine.
Okay,
Fine. How you interact with those inanimate objects, it's good. Anyway,
moving on. Moving on.
So anyway,
what I was going to say is just simply this. I think the Spotify share price reaction was a bit of a read from the Netflix situation. I don't necessarily think that streamers would be in from the point of view of what they're offering as a product. I don't think they've lost any of the attractivity or attractiveness which they used to have. What I think we're seeing here is probably a more technical issue, simply of company valuation. And then we're going to talk about this next or at some point later. But as interest rates rise, the value of the earnings and dividends which is generated by a company are going to be worth less. And that is going to be more pronounced for those companies which have a high growth expectation. And these are all the tech companies. And you see that Netflix cratered when the subscriber numbers were not as high as the city expected. In fact, in this particular case, was 200,000 people left, and the city expected like millions of people coming on. But it's a swing factor, but it's still the same thing. People are pricing in growth, and that growth is not reflected by what is happening in reality. People adjust the growth expectations, and on top of that, you get high interest rates, which is making the values of that earnings stream lower.
Yeah.
And I think that's happening at Spotify, and that's happening elsewhere in the tech sector as well.
No, agreed. Google, I guess, is one of those ones, and seeing a slowdown in growth. But I think it's all, I don't know. I think that the boom time of the last few years is slowing down. I think it's more of a pause for breath than anything else.
Yes, I believe so too. But it's still an interesting topic to talk about because we see this elsewhere in the tech sector as well, in different guys. You might have missed, you wouldn't have missed it, but one might have missed it. But just reading the news, Alphabet, wasn't it, announced $70 billion in share buybacks. Now, at first you think, well, cool, this is excellent. And it kind of is excellent, but it does mean that implicitly what they're saying is that we're not seeing as many growth prospects here, growth opportunities, as we used to. Because otherwise you would take that $70 billion and invest it in these growth opportunities.
Yeah.
Now, technically, from a point of view of stock value, that shouldn't actually matter. But it does matter sort of by extension, because if you have a stock which you would want to own because of its growth potential, and that stock has just basically implicitly said there's not as much growth potential as we used to think, then obviously this this will pause, as you just said. I mean, there will be a correction in the valuation of the stocks, and those stocks who have the cash to give it back to investors might actually counteract and mitigate the downwards correction which you would otherwise get from this. But hidden behind that idea of giving back cash rather than investing it surely must be that for the moment there are not as many growth opportunities in the tech sector to be exploited as these companies were able to do over the last 10 years.
Yeah. Or as you said recently, I thought you put it brilliantly. I think it was in a conversation last week we had where you said share buybacks are a sign that the company's run out of ideas.
Yeah, that's kind of true.
I think that's a great way of saying it. But
yeah.
But anyway, right. Okay. So talking about that, we've got 10 minutes left. 10 minutes left to talk, or roughly, to talk about the next topic, which is companies that will do well, or industries that will do well in environments where interest rates and inflation goes up.
Yes, yes, indeed.
So, I mean, first of all, I thought we'd kick off with banks. I mean, banks classically tend to be the ones that are looked at as doing well, because if the interest rate goes up, it means that they can, simply put, they can charge more for borrowers, for instance. So what do you have to say about that?
Well, yeah, I mean, obviously, I mean, in one way, you might just simply say, if you think about the banking sector, you might just think of interest rate as the price of the product they're selling.
Yes.
Because that's a loan. So if the price of the product you're selling goes up, then obviously you increase your revenues and it's happy days. That's only one part of the equation. The other thing is, if you think about how banks actually operate, it's they sort of take in deposits, and these deposits are there to be lent out to the corporate sector. So you take in short-term deposits and you lend out on a longer-term basis.
Yeah.
The reason you can do that is because not every depositor is going to come to the bank and withdraw the deposits at the same time. That sometimes happens-ish. That's known as a bank run, and we all know that that's negative, and that's happening in Russia, for example, at the moment. Used to happen in the UK, used to happen in Germany in the war, and that's of course a negative situation, but that doesn't normally happen. So therefore, the more deposits the banks take in, the more they can lend out against these deposits. And there's a mathematical formula which I will not share with you, but it's a very simple thing.
No, please don't.
It's a very simple formula. If you sum it all up, then you get a multiple. And this is the multiplier. This is known as the multiplier. So interestingly enough, if interest rates go up, then the incentive to save is enhanced. If it works, then people put their money into the bank rather than spending it in the economy. And that is, as we discussed before, of course, the entire point here, because the central bank wishes to discourage people spending money in the economy in order to curb inflation.
Yes.
So that's the one thing. So all the money ends up with the banks, and this is cool for the banks because they can lend out more, and then interest rates go up and they lend out more at higher prices. It is, of course, not all paradise for the banks, because on the other hand, it's the corporate sector who's just seen its cost of borrowing going up. So there is obviously, like in any kind of financial or business transaction, a trade-off, and there will be an equilibrium point. But yes, in general, this is true. Banks ought to do well. Commercial lending ought to do well out of an environment where interest rates are rising.
No, fair enough. So, so yes, I mean, it is very interesting. Obviously, companies, they have a reporting season, so they all tend to report around the same kind of time. Actually, just out of it, I've got to just say, just a very brief thing. One of the reasons I heard when I was covering Japan, for instance, one of the reasons why the companies used to report not only in the same, few days, sometimes they all used to report on the same day, is because of gangster stuff. Because in Japan, you've obviously, a lot of people will have heard of Yakuza, but one of their one of their activities is kind of blackmail and things of companies by saying, we know this about you, therefore, we're going to ask questions in your meeting. If you don't want us to ask embarrassing questions, pay us a load of money, essentially. And so the idea was that the companies would report on the same day to stop them to be able to go to all their meetings. Now, it sounds a bit weird, but I have heard it a lot actually. But just out of interest, why do they? Do you know why they report at roughly the same time? I mean, it makes it a lot easier for everyone, but why is it?
Absolutely. There's a clear reason for that, and that is to make life harder, specifically for me as an analyst.
Yeah, right. Okay.
Me.
Yeah.
No, I mean, the reason is just simply that the financial year is ending on the 31st of December in Europe and the US. In Japan, I think it ends in March, or used to. And that's just it. I mean, you have to basically, as a company, by the time you are aware of a financial situation, let's say, or event, you're obliged to tell the shareholders and all, everybody who has a vested interest, but specifically the shareholders, you're obliged to tell them all about it at the same time. And therefore, when you do your end of year true up and you do your accounts, then basically as soon as you have done that and finished that particular process, you're obliged to then report to the city or Wall Street. And that's just the reason. So some companies are a bit quicker in this process and they report in February, others are a bit later, they report in March. But that's sort of that's the reason why Q1 is normally full year reporting season. And that's also the reason why all the analysts are extremely fatigued at the end of that.
Okay, yes. Okay, I'm glad you put it in that way. Yeah. Interesting. That is interesting. So I mean, just generally speaking, mentioning it in Watson's Daily, I mean, Deutsche Bank did very well. A lot of that was through bond trading. Lloyds Bank did okay. Standard Chartered Bank did well, but Barclays less so because they had litigation costs and things to contend with. But anyway, so moving on from that, another area of the economy which does very well is in an environment where inflation is going up. It's actually supermarkets. And we've seen some differences in performance with the supermarkets. And on the one hand, we've got some of them trying to cut their prices in order to, I mean, mainly the established supermarkets in the UK trying to cut prices. So like, Tesco, Morrison's and things, they're talking about cutting prices. I think Waitrose did recently. I know M&S did recently. And, they recognise that things are very difficult for the customers, so they're trying to help them. And I mean, that's the one hand you say they're trying to help them. If you're being cynical about it, you're saying they're trying not to lose them. But then it's also interesting to see that Aldi and Lidl are picking up in terms of market share again. But what do you reckon?
Well, of course, absolutely. I mean, there are two things here, perhaps. One is to say that the first point is a bit subtle. Cyclical stocks don't tend to do well when inflation and commensurately interest rates go up. Excuse me. And therefore, by excuse me, oh dear, this is clearly a contented subject. This can't speak about it.
Yeah.
And by implication, therefore, non-cyclical stocks are less affected by the potentially negative impacts of rising interest rates. And these are, of course, food. Anybody who's got anything to do with food. I mean, supermarkets, because people got to eat, and therefore there will always be demand for the products they offer. So that's point number one. But then, of course, demand is one thing. an ability to pay for your food is another thing. And again, we go back to Ukraine and the looming food crisis and cost of living crisis, etc. So people have less money to spend on food. And for that reason, obviously, those companies who are discount providers are doing well. And so it's a no-brainer. I mean, it's obvious, isn't it? I mean, we discussed it last week, I think. What can you do in order to lower your household expenses? Well, one thing is you lower basically all the expense items you have. The most important one of the most important ones is food. And rather than going to Waitrose, where you buy your helicopter fuel or something, you go to Aldi, where you may not be able to buy that, but of course or Costco. Costco. Have you ever been to Costco? This is just absolutely astonishing. I mean, people.
Funnily enough, in one of this week's Watson's Dailies, at the end, I actually put on there. There's a brilliant video on YouTube about the 5 stages of shopping at Costco, and it's really funny. So
cool.
definitely have a look at that, because that is brilliant. But yeah, Costco is interesting.
Costco
but to be honest, I reckon to go to Costco, you've got to have quite a big house, because everything comes in massive packages. So,
this is why I find this amusing. I mean, also everything is like. Disney World and all these kind of things. This is like supermarket world. I mean, you go there and everything is supersized.
Yeah.
You don't have trolleys. You have these little tanks which you which you manhandle around. And as you say, I mean, everything is like you want to buy like 3 potatoes or whatever. That's not available. But let's have a sack of potatoes. Like unbelievable.
Want some ketchup? How about 24 bottles? It's like okay. So, like, if I've got a nuclear bomb shelter or something, then maybe I can stock up there. But yeah, for most normal people, I would suggest that yes, it is a bit tricky.
But it makes sense because it's cheaper there, and so that should actually work. And of course, Aldi and Lidl, sure, they're going to do well out of this. And what we're also seeing is what you said, these sort of mid-market supermarkets like Aldi, Asda, Tesco, Sainsbury's, and others are lowering their prices to the extent they can. And of course, the marketing speech is to help the customers, which is to retain customer base. But there's nothing wrong with that from a corporate perspective. And the extent to which you will be able to do this is clearly this sort of what is known as elasticity of prices. I mean, you lower. Actually, it goes the other way. When you lower your price, you get more demand, but then obviously also you get less revenue, and you have to actually find the line which is still going to allow you to write a profit. So the extent to which the mid-market supermarkets can lower prices, and clearly also the upmarket ones like M&S and Waitrose, is going to be limited. And I think that if you look at the supermarket sector in specifically, then clearly Aldi and Lidl and the discounters are going to win the day.
Brilliant. So there we have it. So it's. I mean, we've gone slightly over time, but I mean, I think that was good. I think we've covered a lot of ground there. But yes, a lot of food for thought. See what I did there? Sorry about that.
Oh my God!
I don't know. That
You're the
intended.
funniest man.
Yeah, I didn't intend that. Intend that. It just came out. I'm so sorry.
Let me first digest this before I go.
Okay, brilliant. Hey, right, and I've just got to say, I just realised while we were doing this that if people wanted to buy your book, you've got a different name. You've got you've done a proper writer's thing, in that you've got a different name.
Yes. My real name is, as you guys may know, Ralph Hepken, and my sort of pseudonym for writing books is Mark Hebwood.
There you go.
And
Mark
Mark Hebwood. The reason for that is only because when I wrote the book, I was still an analyst, and I didn't want brand conflict. Basically, if you Google an analyst, any analyst, lots of stuff comes down, and I just didn't want that to be to interfere with this. That's the only reason. And also, it sounds more English.
Yes. Mind you, though, are you sure it's not because you're like, I don't know, like some sort of James Bond or something like that? And maybe you wanted, it was like for security reasons. That's what it was, wasn't it?
But who knows?
Eh?
Can't tell you.
Right. Anyway, on that note, we'll stop there. But look,
Yeah.
thank you very much as always, Ralph. It's always brilliant to speak to you, and hopefully other people will be overjoyed to actually see you actually talking.
I'm sure about that, but
on the video version. So yeah,
I'm
brilliant.
unsure about that. But it's always fun being on the show. Thank you very much for inviting me back,
No
and it
problem.
was great.
Good stuff. All right, mate. Well, look, we'll be back again next week, I guess. So thanks very much.
Absolutely. Thanks,
All
Peter.
right.
Cheers. Bye bye.
Bye.